Hi, and good evening to everyone. Firstly, thank you everyone for joining this call, this webinar on monetary policy code. The objective of this call would be to understand the various aspects discussed in the monetary policy meeting, which was concluded in the morning. For that, we have with us Mr. Parijat Agarwal, who heads the fixed income function at Union Mutual Fund. We also have Mr. Saurabh Jain, who is the Chief Marketing Officer. My name is Ishan Amerkar and I work in the products team at Union Mutual Fund. Without taking much time, I'll hand it over to you, Parijat.
Thank you, Ishan, and thank you, Saurabh. So today was the outcome of the monetary policy committee, and the governor read out the statement. I'll share the PPT. Is this visible? Full screen?
Yes, Pai. Can you put it on the slideshow, please?
Yeah. Just hold on. Is it full screen now?
Not yet, sir. Huh.
Or you can start. Maybe it will come with a lag.
Yeah. Now it is there.
Yes.
Okay. So the MPC, decided to stay on pause. So the repo rate remains unchanged at 6.5%. SDF rate remains at 6.25%, and MSF rate and bank rate remains at 6.75. So basically, no change from the last policy. The repo rate remains unchanged. In terms of the stance, the MPC also decided to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. This also remains the same as was in the last policy. Now, the decision to keep the policy rate unchanged was unanimous. However, the stance, that is withdrawal of accommodation stance, was 5 members voted for and 1 member voted against that stance. So it was in line with what a market was expecting, that policy rates would remain same and stance would remain also same. Now there are a lot of details in the policy which tells us that what was the thought behind the idea of keeping the policy rate unchanged, and also what has been the projections for the inflation and growth. In terms of the growth, if you look at the GDP growth projections, it has been kept same at 6.5% for FY 2024. It was the same in the last 4 policy meets. Since from April to 23 policy, we see that the projections from the MPC is at 6.5%. Although there are some small changes in that, if you see quarter over quarter, but that also has remained largely same. So second quarter 6.5%, third quarter 6%, fourth quarter is 5.7%, and first quarter of FY25 at 6.6%. So the growth projections has remained same, and it tells us that the MPC is quite confident about the resilient growth of the India's economy. And what were the factors which tells us that India's growth is resilient and it is expected to do well going forward also? The factors supporting growth: A, if you look at the various PMIs, manufacturing PMI and services PMI, they have remained extremely robust. In fact, India's services PMI came at 61 in September. It was 60.1 in August. The urban consumption is buoyant, and the rural demand is also showing signs of revival. The various high frequency leading indicators are pointing towards that. The investment activity is benefiting from public sector capex that is visible across sectors. It is whether it is metals, oils, cement. It's across sectors. It is visible. Strong growth is seen in steel consumption, cement production, as well as in imports and production of capital goods. This is a clear sign of that investment activity has picked up. and it is expanding. One important aspect of to understand how the growth is moving ahead is to understand the capacity utilization in the manufacturing sector. It has continued to trend up, and the capacity utilization improved from 74.1 in Q4 FY23 to 75.4 in Q1 FY24. This is, in fact, it has remained above the long period average, which is somewhere around 73 and a half. So it clearly tells us that investment activity is robust in the economy. Now, the another important thing is to understand is that upcoming festival season is expected to provide support to private consumption and investment activity both. This is also, will become visible from high frequency leading indicators as the festival season starts to get over. Now, there are certain risks to these factors which are supporting the growth. One is the economic slowdown that is visible. So what we've seen is that the growth numbers in the eurozone and the Japanese economy is actually slowing down. Global growth has slowed down. The only exception is that about the United States, where the growth has remained resilient. Volatility in global financial markets can definitely impact the growth numbers, because the recent sell-off in the US bond markets and subsequent strengthening of US dollar definitely puts the global growth and the currency in difficult situations that could impact the global growth also. Protracted geopolitical tensions that we have seen, because it tends to push up the inflationary expectations, because it impacts the longer it continues, it impacts the your food and energy prices. So in fact, 2-3 days before, we had seen that the oil had touched close to $97 a barrel. Although it fell, it is trading somewhere around $84 a barrel. So another is that the climate risk. The climate risk has turned to be a major risk factor for the inflation, and along with that the growth numbers, because it has started impacting the various geographies in different manners by changing the climate. Now, if you look at what were the projections for the inflation, and which kept the MPC on hold. If you look at the inflation projections, the MPC has retained the full year projection at 5.4. It was same in August policy. So what they had hiked by 30 basis point from the June policy, they have retained at for the full year at 5.4%. The second quarter, they have increased the projection by 20 basis to 6.4. The third quarter is 10 basis down to 5.6. Fourth quarter remains same at 5.2. And first quarter of FY25 remains at 5.2. So in terms of the inflation projections, it has been same what has been in the last policy. What were the various factors which tells us that the inflation numbers would remain same? One thing to understand is that the headline inflation, which stood at 6.83 in August and 7.44 in July, was largely on account of elevated food prices, and food prices tends to be transient, and last time it was largely because of vegetable prices, and which has weightage of around 6%. So these are expected to cool down in coming months. So in the near term, the inflation is expected to trend downwards, but overall it would still be above RBI's rate of 4%. For the full year, it would be at 5.4%. The crude oil prices, which had firmed up in recent weeks, and outlook was clouded by demand supply, has started to trend downwards. What we just spoke to, it is somewhere around $85 a barrel. So there is again a good thing to understand that crude prices have softened from being from $97 a barrel. On the positive side, what the MPC highlighted, that inflation excluding food and fuel, what we call is a core inflation, has softened by around 140 basis points from its recent peak in Jan 2023. So that's a very healthy sign. So that gives a lot of comfort to the MPC to remain on hold, not to hike the policy rates, because a large part of inflation was coming from food, and which continues to remain very transient. Now, what could be the various risk points to these projections of the MPC? First is that low reservoir levels, which the MPC has highlighted, because the monsoons has been, the special distribution has been different at various places. Somewhere it has been excess, somewhere it has been low. So that impacts the food production, or the crop production. Adverse climate risk is definitely how it impacts the food production, the crop cycles. It sometimes there are excess rain, sometimes it is drought, so it impacts the crop production. Supply side shocks can continue based on the global demand supply issues. Sustained increase in domestic food prices because of the various factors like your low reservoir levels, adverse climate risk. What we have seen is that earlier it was the vegetable prices. Now it is somewhere around cereal. It is also impacting somewhere around the lower production of spices. So it may continue in this fashion and put upward pressure on food prices. Global commodity and food price outlook remains clouded because of the uncertainty of the geopolitical situations. So that can continue to put risk to the inflation projections that we have at 5.4% for the full year. The most important point to note from this policy, because most of them, as I highlighted, the growth projections, the inflation projections were the same what it was in the last policy. What was different in this policy, which tells us that the MPC and the RBI is very concerned about the inflationary expectations, and would like to maintain or have a check on that through the liquidity. So obviously, once the 2000 rupee notes came into the banking system, close to 2.87 lakh crores. So obviously, the banking system liquidity has been, in surplus. So obviously, when there is a surplus liquidity, there is secondary round of inflation expectations, which anyway, the RBI wants to control and keep it tight, so that inflation doesn't run away. So last time in the policy we saw that they had done what we call is ICRR, incremental CRR. So which anyway is getting over by tomorrow. So the last phase of 50% of ICRR would get over by tomorrow. Going forward, the terms of the festival season starts to kick in. There's a lot of currency leakages happen, or the withdrawal of currency happens. So obviously that would put as a counterbalance what the money is coming back in the system. But the RBI is extremely concerned, and what they're doing is that they are trying to keep the liquidity extremely tight. So this time, what they mentioned that they would be doing open market operation sales to manage liquidity. This, they say, is in consistence with the stance of monetary policy, which will remain disinflationary and tight going forward, as long as it takes to bring the inflation down to 4%. So obviously what this means, this open market operation sales means, is that RBI would sell bonds in the market from its own books. So obviously the supply of the bonds would go up, and obviously the demand is poor at this juncture, because anyway we have the government borrowing and plus this, so that would put upward pressure on the bond yields. Now the timing and quantum of such operation will depend upon evolving liquidity condition. This is what the RBI highlighted. And how these would be done, the operations would be done. This would be through auction route. Normally what happens that the RBI continues to buy bonds to manage liquidity on a regular basis on the NDS home screen on the secondary market. So they keep buying bonds in small lots. But this time they have mentioned that it would be through an auction route, just like the way bonds are auctioned for the government borrowing. So definitely it is going to put upward pressure on bond yields, and that's what we noticed today, that bond yields got sold off heavily today, and yields were up by close to 8 to 12 basis points as I'm speaking to you, because this is definitely for a short term or in the near term is not very positive for the bond market, because the supply increases, and moreover there is no calendar for this. So obviously we do not know when the RBI would come and announce open market operation sales and what would be the quantum in the second half of this financial year. So definitely RBI is managing rates through liquidity and various tools of liquidity rather than any change in the repo rate. So this is a very crucial point to understand from this policy. This is what they have done. The same thing they had done in the last policy, where they had hiked the by through ICRR, where the overnight rate shot up to 675 from 6.5, where normally it used to remain. So it became so tight, it went up to 6.75. Another point to understand in liquidity is that there is skewness in liquidity in the banking system. So some banks are surplus in liquidity, some are deficit. So obviously, RBI is trying to manage this liquidity in an orderly fashion, but through open market operation sales definitely puts upward pressure on market yields. So today, the entire yield curve has shifted up right from 2-year to 30-year by 8 to 12 basis points. That's the impact, because markets do not like uncertainty, and this has thrown uncertainty in the bond markets in the near term. India's foreign exchange reserves are comfortable and stood at 586.9 billion as on September 29. If we look at the credit growth, it remains very robust. This is again one more factor to tell us that India's growth remains resilient. So the non-food credit remains at 19.8%. If you strip out the HDFC effect, it is at 15.1. Similarly, the deposit growth is picking up, so it is at 12.3%. So credit growth is at a multi-year high on the back of economic expansion. That is very, very visible, as I discussed also in my earlier slides. Increased capital expenditure and implementation of the PLI schemes and push for retail credit. So that's definitely, that on the growth aspect, we are quite comfortable. However, the risk is definitely coming from the inflationary expectations, and that's why the MPC or the RBI is trying to manage the expectations through various means. So this time they are managing it through the tight liquidity. The one good information is that inclusion of India bonds in global bond indices. So in the near term, this open market operation sales may be negative for the domestic bond market, but overall the inclusion of India bond in global bond indices remains a very, very healthy sign for domestic bond market in a longer term perspective. Obviously, the bonds would be included starting from June 2024, and India would get a weight of 10%, which will be added from next year. The AUM of funds tracking the JP Morgan GBI EM family of indices is about 236 billion. So rough cut estimates tells us that close to 23 billion inflows we can expect for a period of 10 months. Now this also opens up door for inclusion in the other global bond indices, namely Bloomberg Global Aggregate Index, where India's weight could range from 0.6 to 0.8%. Additional 15 to 20 billion, but again it depends how and when that happens. But yes, the door has opened, and it could happen anytime next year, or maybe after that also. So that's a very healthy sign for the domestic bond markets. Now, if you look at in totality, the growth, inflation dynamics, the liquidity various tools being used by RBI, the fixed income markets are looking extremely attractive today, despite the yields going up by 10 to 12 basis points today. Because as I'm telling you, it could be for a short term, but from a longer term perspective, the bond markets looks very attractive. Your real policy rate continues to be positive. So repo rate at 6.5, projected inflation is 5.4, and in terms of RBI's own projection, the inflation is expected, the headline inflation is expected to be around 4%, which is their target by second quarter of next financial year. So obviously you have a very, very healthy real rate. The global central banks have put a pause on rate hikes or are on the last leg of rate hike. So we saw that US Fed also stayed put. The various central banks, the Bank of England, Bank of Australia, Bank of New Zealand, Bank of Japan, they've all put a pause. So ECB also has put a pause, with obviously a little hawkish tone that if required, inflation runs ahead, they may take a call to hike the rates. But definitely, the commentary is that it is on the last leg of a rate hike. So RBI is ensuring adequate liquidity for operative requirements. Obviously, our forex position is comfortable. The expected inflows, we could see from in the equity markets and going forward in the bond markets, the passive inflows would come in by way of inclusion in JP Morgan Global Bond Index. India's external debt ratios are low by international standards, and external sector remains very resilient. Our current account deficit remains very, very comfortable and manageable. Closer to 2% is very, very comfortable position. So not a much concern from external sector. And domestic inflation, as I mentioned, it is expected to fall towards 4% by second quarter of next financial year. It may remain above 5% for this year and maybe the first quarter of next financial year also. Now, the risk to all this, the looking attractive for in the near term negative is that the higher quantum of RBI OMO sales, the geopolitical risk in global inflation trajectory, and sustained increase in global crude oil prices. What we had seen, a few days back. If it remains like that, yes, definitely, rates would remain higher for a longer period. But one has to understand that even if the rates have to remain higher for a longer period, one is getting a very higher accrual. So even if today I'm getting a very high accrual of on the GSEC 10-year at 7.35, 3 to 5 year corporate bond at somewhere around 770, 775, and in a year's time, when actually across the globe we see that the rate softening starts to happen, one could see the M2M gains to start to kick in. So definitely a very high accrual rate, a very high real yield is also there, and inflation expected to go down. Obviously, little it may take little more time. Definitely, the total holding period return would be very, very attractive, and much better than your the I would call fixed deposit kind of products. So from a longer term perspective, the bond markets look very attractive from medium to long term. M2M gains to accrue as rates start to soften, maybe by next quarter of next financial year. So in totality, short term volatility would be there, and today what we have seen in the global markets as well as the domestic markets, that volatility of 10 to 15 basis points has becomes the norm. So like we saw that the US 30-year touched close to 5%, came back to 4.85 just in a day's time. So that kind of volatility has become very, very normal these days. But one has to look through these short-term volatilities and continue to focus on the wealth creation that would happen only by looking at a longer term remaining invested in bonds. then the total return would be very, very attractive. And we have two products which definitely today offer a very, very attractive return. One is our corporate bond fund, where we invest in basically in 2 to 5 year corporate bonds and G-Secs, where we generally run around 2.5 year to 3 year of modified duration. The accruals are upwards of 7.5%, and as I mentioned, even if 50 basis rate cut happens next year, you can add the M2M gains, so returns could be quite healthy. Those investors who are willing to take the volatility, much higher volatility, but are looking for a high return, we have a gilt fund where we invest in G-Secs and run a very high modified duration of upwards of 5 years, where the accrual of 7.25 and a very high duration of 5.5 would definitely, the M2M gains would be much, much higher. So the total holding period returns would be very attractive in gilt fund, but yes, one has to look through the short-term volatilities. So that's in a nutshell what we see in today's monetary policy and the bond markets going forward. So
Thank you, Parijat.
yeah.
Parijat, there have been some news article in US which are talking about that these current rates may be the new normal,
Yeah.
and that expectation of low rates
Mm-hmm.
are not right because these may be the new normal rates which the economy may see for a long period of time. What's your view on that?
See, what people are saying is that obviously one had to understand that inflation is very high today. It definitely, the higher rates for a longer period would impact your growth, and the inflation would definitely starts to trend down. So real yields are generally not, seen as much higher than 1.5 to 2%. Then it starts to impact your growth also. So in our expectation, what we believe is that going forward down the line, yes, we will not go back to what levels were there. So 0% or 1%, but definitely not these higher rates would remain. So for example, in our case, if the repo rate is at 6.5, definitely repo rate, there is room when inflation is at 4% for the repo rate to come back to 5.5. So that's the kind of expectations, or one can have an assessment.
Thanks, Parisa. We have a couple of questions in the Q&A box. We'll take them one by one.
Yeah.
Firstly, when do we expect the rate cut cycle to start?
See, as in the press conference also, the governor highlighted that earlier, the RBI's target was 4% plus minus 2%. But today he very, very categorically said that their target is at 4%. So obviously, nothing would change unless the target of 4% is reached. But at the same time, their projection of reaching 4% is by second quarter of next financial year. So that's what I said, that any rate cut cycle would start from the second quarter of next financial year.
Pai, I have a follow-up question on this.
Yeah.
So, is India rate cut dependent on the US Fed rate cut?
To a large extent, yes. So there also, if you look at the dot plot of the US Fed, they are also building from June 2024 any rate cuts. So that's why second quarter we are saying that. So because if you do a rate cut and the US Fed is not doing any rate cut, so obviously it puts pressure on our currency, because the rupees would definitely get depreciated. So that is definitely a point to understand. But as per the dot plot of the US FOMC, June 2024 is when they expect rate cuts to start happening.
The next question is, how will the tightening in liquidity affect bond yields?
Yeah. So bond yield and liquidity have a very important connection, because whenever this liquidity is tight, obviously I'll demand a higher premium to hold the bond, because when money is tight, so to buy any bond, definitely I'll ask for a higher yield. So and this time last time what they had done was that CRR. So you had taken liquidity out from the banking system. So obviously your overnight rates shot up because you were borrowing in the overnight rates. This time, what RBI has mentioned that they will do open market operation sales. Basically, they will sell more bonds. So when you sell more bonds, and then what you do is that you sell bond and take out rupee from the domestic system, liquidity from the system. So obviously, more supply for the bond, money going out from the system. So I'll demand a higher premium to hold that bond. So obviously yield should go up. So I'll demand a higher yield to hold that bond. That's how it would impact the domestic bond yields.
So when Pajat, you mentioned that this is a good time to come into the fixed income long duration fund
Yeah.
and high probability of outperforming the fixed deposit return.
Yes.
So if you're looking at a yield of 7.25 or whatever 7%
Mm-hmm.
pre-expense, and we factor in some mark-to-market gain which may happen sometime in the future.
Yeah.
So
Years down the line. Yeah.
yeah. So my question is that if someone is coming into Gilt and have that mark-to-market gain in mind, minimum what time frame should he keep? 1.5 year, 2 year, 3 year? What should he keep?
1.5 years is a good time frame.
If someone has 18-month view, there's a high probability of him getting a
Yes.
mark-to-market.
Yes.
Okay.
Definitely yes.
So following the addition of Indian bonds into the JP Morgan index, what kind of inflows can we expect in the Indian bond market?
See, the total AUM of the GBI group of indices is 236 billion, and India would get a weightage of 10%. And it will start from June 2024, and every month they will increase the weight by 1%. So over a period of 10 months, we'll expect to get a flow of somewhere around $23 billion.
Will it also impact the active money which was coming in India? Will it go
Yes,
up?
it is generally seen. So whenever the bonds are included in global bond indices, before the actual event, the active money starts to pour in and start taking positions because they know that these flows are going to come in. So we expect that active money to start pouring in from March, April onwards next year, 2024. So that's why I mentioned that OMO sales, the impact would be short term in nature, but if you look at a longer term, it is very attractive.
Let me just check the Q&A box quickly.
Yeah.
We have a question. Should we go with a long-term bond with average maturity of close to 5 years, or a shorter duration bond fund which will have an average duration of lesser than 5 years?
See, as I mentioned just now, that if you're looking for a lower volatility and reasonable return of corporate bond is the best, where we run an average maturity of somewhere around 3 years. But if you're looking for a higher return and higher mark-to-market gains, but remain invested for 18 months, as I sort of mentioned, then Gilt fund or a longer duration fund, which is definitely is the more attractive than the corporate bond fund.
Thank you, sir. We have certain questions on the equity side.
Yeah, I'll take it, Ishan.
So I will take it. Yeah.
So firstly, at this time, is it a right time to invest into small cap fund for a period of longer tenure? And what would be the preferred mode of investing?
Yeah, so if you look at the markets for last 1 year, the rally in the small and mid cap have been very, very strong. However, the rally can continue driven by the flows. So if you look at the mutual funds flows via SIP and lump sum, there's a big chunk of money coming every month into the small and mid cap phase. Now, valuations are expensive, but they are not frothy. At this, at these valuation, ideally you should be coming via STP, staggered way over a period of next 6 to 12 months into small and mid cap. That's the way that we would look at the investors coming into small and mid cap right now.
Thank you. We have a question on innovation fund. Our level of deployment in that fund.
Yeah. So our fact sheet is out, and we have deployed the full portfolio. We have invested the full money. So the cash holding as on month end is close to 6-7%, which we normally maintain in the funds for the liquidity purpose, right? Because there are various inflows happening at various points of time. So the portfolio is fully deployed as on month end.
Thank you. With that, we complete the questions.
Okay. Thank you everyone for joining in.
Thank you.
Thank you.
Thank you.